Hello there everybody, welcome to the latest Pipnotic Symposium on the 9th of January 2017. Okay, today we are going to have a look at some pretty specific things. First of all, we're going to have a look at entries, stops and targets. So we'll be doing an analysis, we'll be identifying areas of supply and demand, and we're going to find a place for us to make sure that we can put our entries in. We're going to find protection for our stops, and we're going to find areas that we can use to target for profits. And so I think this will be a pretty interesting and important lesson. And then we're going to have a look at a quick update that I've made to the indicator that I'll release here shortly. And then we'll do some top-down analysis and see what we can find. Additionally, we'll run through the pound chart that we looked at last Monday, and we'll see how those levels held, just so we have something to look at. Okay, so the agenda, there it is. We just talked about that. So interest rate swaps, very quickly, the update for the software. Interest rate swaps are very interesting because they show us which currency is attracting flows and which currency is not attracting flows, rather which currency people are liquidating or getting out of. And this is important because this is pretty much a driving price. So if you consider the health of an economy, you can look at all of the data points on, for example, Forex Factory, and you can see that employment is going well, production numbers are going up, and this causes inflation. And when the economy inflates, it starts to expand and get bigger. And a general target, a rule of thumb, is an annual inflation rate of about 2%. If inflation gets to this level and attempts to move through this level, then the central banks will generally try and thwart this by their main instrument is to hike interest rates. So by hiking interest rates, they slow spending, and this will make the inflation soften slightly and perhaps even unwind a little bit. And so it's very important to do this. And why is it important? Well, this is because that the currencies with high interest rates, they're going to give a better return on your money. So people are going to typically buy currencies where you can have a really good long-term investment. So in the old days, my mentor Chris Laurie used to always talk about the carry trade, and his carry trade was buying the Australian dollar, Japanese yen. The Australian dollar had really good positive interest rates, and the Japanese yen had bad, sometimes even negative interest rates. And so flows would move into the Australian dollar and out of the Japanese yen, of course, causing the price of this pair to move higher. And so being able to see this information on a price chart is really interesting, especially if you're looking at longer-term trades. Christian, can you see my chart? Just to make sure that I'm not recording black space. I think you probably should be able to. Okay, so if we have a look at the chart here, you'll see that we'll go here and we'll have a look at the configuration. And you'll see here that we have a new setting, and this new setting is called Enable Rate Swap Colors. When this is set to true, the indicator is going to color this just here. You can see that the range information is colored red. If we go to the Euro American dollar, see what's going to do. Slow down for us. Let's try and grab another pair. Yeah, okay, if we go to the Australian dollar, American dollar, you can see here that it's green. We go to the Euro US dollar, let's go on, you can see it's red, dollar CAD, green, the Kiwi, it's green, the Euro Yen, it's red, the dollar, yeah, we just looked at that. And so this is a really good way for us to see what's going on in relation to the interest rate swaps simply by looking at the color of the range information or the dashboard. And so I've included this because longer term trading if you have negative swaps and you're buying a particular currency pair, then you'll be paying money every night. So every time the clock ticks 12 at your broker, you're going to be charged the interest, the negative interest on your account. And if you have big position sizes, this can be very, very expensive. On my algo trading VPS, it's doing some trading with it's simulating with a lot of money, so $500,000 on a demo account, and I can see there that if it's trading against the swaps, that it's paying about $100 a day on some of these positions, sometimes $150 a day if the spreads, if the interest rate swaps are really, really big, and so it can be very, very expensive. So just keep that in mind, and it's a nice feature I've wanted to add for a while, and now it's there, and I'll update that here, or I'll release it here shortly. Okay. So if we go back to the slides, we're going to have a look at now at entries, stops, and targets. Okay, so if you look at a price chart, you identify an area that you want to sell at. We won't go into detail with that just yet, but we'll just, for the sake of example, show this price chart. And so you've identified on the euro Japanese yen, the 126.30 area. You think to yourself, okay, I want to sell there. Again, a quick note: interest rate swaps will be earning interest every day when we sell the euro Japanese yen, which is lovely. So even if price moves sideways, we'll still be earning money. Okay, so we identify the level here. So we use the method that we use to identify the area, and you can see that we had this accumulation candle just here. We had a really nice release, this green candle, extended range candle. It left the area of accumulation. It came back, it tested the bottom of the accumulation, and then it dumped south very, very quickly. And this is really nice, because then what we need to do is we take the rectangle drawing tool, and you simply draw the rectangle to start off with. So you draw from the high to the low of the accumulation, like so. And it draws this here. Then you can see that we have this number here, which is the upper edge of the box, the supply box, and then we have the lower edge of the supply box, which is this value here. Then we have a number in the middle here, which is the first number is the size in pips of this area of supply. So this is 191 pips deep or wide. Then we have a slash, and then we have 0.01. And what does that mean? Well, 0.01 is actually the indicator telling me the size of the position that I should be trading. And I'll show you where you configure this information. You can see just here there is something called a risk. And currently on this account I am risking 0.25%. So the indicator will read this value, it'll look at the size of the area of supply, in this case supply, and it'll say, okay, based on the size of your stop, which is 191 pips, if you're risking 0.25%, you can open a position with the volume of 1 microlot. If we change this to, for example, 1%, so we're risking 1%, and we press OK, then now we can use 5 microlots. And so the indicator is simply going in and doing this small calculation for us, so that we don't have to sit there and guess and mess around. And it's just a really handy tool to use here. Okay, so if we've identified this area here using the rectangle, and just a bit of supply and demand theory, you can see that when this area was established, price left the area of accumulation very nicely. So this candle closed below the bodies of all of this accumulation here, and price went back up. We tested the edge of this accumulation, supply, and then price went down. And now price is coming back up to this area now, and we're expecting some kind of reaction up at this level here. And so our entry is going to be here. And why is it going to be here? Well, it's going to be here because when price came up and retested this area of supply, we had a very strong reaction. What does that tell us? Well, if you consider for a second, let me draw something here. If you consider supply and demand as stacks of pancakes, I like to call them stacks of pancakes. So in the bottom here we have We have a pancake here. This is the bottom pancake. We have the second pancake, third pancake. So let's assume in this area of supply we have 4 pancakes, and then we have people here, and these are the people that are looking to trade, and we'll consider these people to be forks. And so the people that are trying to sell are looking to sell at a high price, because they want to sell at a high price to ensure that they get the biggest returns on their investment. So they have the forks. When price comes up to the level that we're looking to sell at, you have to look left and you have to look here, and you have to say, okay, how deep did the fork reach in this stack of pancakes? And you can see here that the first pancake, which is just at the bottom here, like that, has already been eaten. So the first one is gone. And then you have to look up a little bit deeper. Then you have to look for the second pancake. But how do you know where these pancakes reside? Well, I'll show you. It's very easy. What you have to do is you have to simply mark off the high that went into this area of supply. So the area of accumulation, supply, between the bottom of this rectangle and the blue line, that's one of the pancakes. That's the first pancake that's been eaten. The second pancake is located just above the high of this extended range bar here. And so to find enough liquidity to cap our price, to hold it lower, to make it move lower, you want to go to a place in the market where price has not been before. Price has been all the way up here to the level of 126 spot 486. So price has already been that deep. So you don't want to sell for a price any cheaper than that. So that brings us up to the next area, which is 126 spot 44. So that's the area that we want to consider to trade at. And so what we'll do is we're simply going to put an order in to sell at roughly that area. Now you don't have to get like all nitty-gritty and focus too much on the details, but just ensure that you're getting in around the highs and your stop is going to be above here. So we're just going to put this trade on. We're going to risk 1%, and we're going to sell at the top here. Okay, so according to the risk profile, so I'm allowed to risk 1%. I'm allowed a position size of 5 microlots. I'm going to sell. I'm going to sell at 126.30. 26. We'll say 31. And sorry, that was a stop. We're going to go put that down here. The stop is going to be 128.23. We'll just put it 1 pip above the high. And the volume is going to be 0.05, so 5 microlots, like so. That disappeared on me there. Okay, super. And then the target we'll have a look at in just a second. So now we're going to put that in. We're going to sell. Good. Okay, so we've got the order in now. So now we're looking to sell. And just what I like to do is I like to hold the mouse over the stop just to make sure that we're risking 1%. So this account is about $10,000. So I don't want to risk any more than that. Yes, okay, so it's about just over $100, $110 or so. And target-wise, I mean, where would you want to take profit? Well, if you look at where price is now, you can see that we have this price imbalance from the bottom here, and it's moving higher, and we're expecting some kind of a reaction here. You can see also that we have an upward sloping trend line here, so we have a low, we have a high, and price drifted down to a low, and then we have a higher high, and we'd like to see price respect this trend line at some point. So if price manages to come up here within the next couple of weeks, then we're expecting price to come down and feed into this this price inefficiency, this liquidity void here, and target the bottom here. So you can see that we've had, if we have a look here, you can see that we had a test of this level of supply. I'm just going to mark that off. I'm going to zoom in a bit. So we had an area of supply as established, price tested it once, it tested it twice, and on the third test, it moved through it. Then you have to ask yourself the question, what area of demand consumed the supply? Then you have to move this area of supply, which is no longer valid because it's been consumed, and you move it here. You move it like so, like that. And so this is where our target is going to be, because this is the next logical place we expect price to react at. You can see that we had the highs here at the 116.32-ish area. I like that area better because this is the high that was tested multiple times and then price finally broke through. So I'm going to move my target down here and I'm going to put it just above, maybe just above there, just to be on the safe side. And I'm expecting price to react there. So we're risking on this trade, we're risking $100 and we're expecting about 550. So a 5-to-1 reward risk, which is not so shabby. So that means that if I take 5 trades and I lose all 5, and I take one trade, this trade, and it wins, then this one winning trade wipes out the 5 previous losses, which is really nice. This is what we want to do. So you want to ensure that your risk rewards are looking pretty good. Okay, so we've identified the area of supply here, and your entry is simply going to go at the bottom of the box. And this is just to recap. So it goes at the bottom of the box, roughly at the same area price tested on the release down. And your stop goes above the area. So the next stop, so your stop for this one will be just over the top of the area of accumulation slash supply in this case. And then you're good to go. And the target is simply opposing area of demand. And so you use these rules to get into trades, but you also use the exact same rules to get out of trades. So when price comes down here, what are we going to do? We're going to buy it back. We're going to sell it here. When we come back here, we're going to buy back our position with a nice profit if everything goes as planned. We also have an upward sloping trend line, which is great. We've also had this downward sloping trend line, which is broken, which tells us that we are actually in a weekly uptrend. And so this is counter trend, but we expect to get some kind of reaction there because we have this price inefficiency here. Price is currently out of balance. So if we want to get price back to the equilibrium, we have to come back to roughly this area here. And this will overlap nicely, converge nicely with this upward sloping trend line and roughly at this area of demand. We might also come to these highs here, we don't know, and have a reaction just here, but we don't know. So what we'll do is we'll wait for price to come up here. If we get a reaction, we'll wait for price to come down here, and then we'll see what happens. Fundamentally, we want to make sure that the news releases that are coming out of Europe and Japan support our bias, which is to sell. And you have to keep this in mind. This is very, very important because you could sell an area of supply and everything's looking great on Monday. So you're buying the Japanese yen, for example, and on Tuesday, the Japanese central bank, they hike interest rates. Is that good or bad for the trade? It's bad for the trade. It means that the yen is going to gain, it's going to track flows, and this is going to move us against our position. So then you want to look for a place to get out of the trade, or at least reduce your risk, because then you know that fundamentally the market is no longer supporting your position or your bias at the time that you decided to enter the trade. Okay. Okay, super. What else do we have? Well, we have actually another lovely area just up here. This is very nice because if you have a look at the supply and demand quality checklist video in the members section, there's something called the depth of the curve. And the depth of the curve simply shows us how deep in the retracement we currently are. And so if we consider this, we have a high, a major high, major low, major high, major low. So between this major high and this major low, we want to know how far up how far we're retracing from this high to this low. And for this you can use fibs. You go from the high to the low, and you can see that our entry is located roughly at the 50% Fibonacci retracement, which is pretty good. It's a pretty deep retracement. Well, it's the middle. So we've had a 50% retracement from the high to the low. So price has given back this much of the losses. And this will line up nicely with this area of supply. If we look at the area just above, we have another one here, and this is a little bit deeper. And this is the 62% Fibonacci retracement. And so this is pretty much what we want to pay attention to. Okay, Christian is asking, actually I have two Danish people in the room. When would you move your stop if the trade goes in your direction? Well, ideally, what you want to do is you have to, I mean, before you move your stop, you have to study what price is doing. So if price comes up here and we get a nice reaction, price moves down. If you move your stop to break even immediately, you could very likely get stopped out because price will want to retrace to accumulate sell orders in order to move lower. And so it's best not to fiddle with the stop until price is able to break a trend line. We have an upward sloping trend line here, which is lovely. Let me draw that in. Price is moving up like this. So we want to see, assuming that price respects our level, we come up to our level. And then price comes back to our trend line. And we want to see the trend line get broken. And when the trend line gets broken, we're qualifying this area of supply as supply. Because, why? Because it broke this trend line. And then you can move your stop. You can move your stop from up here above this weekly supply to here above this daily supply. So now we've reduced it because we're not expecting price to move through that because this is qualified supply and it consumed this area of demand here. So price will consume this, it comes back up here, we test this, you'll have to stomach that. Price will, when it comes up here, it'll probably react pretty strong and it'll move off and it'll move 100 pips. And then you have to be patient because price is going to come back. It's definitely going to come back. It's going to test this area of supply here because this is what is required in order for price to accumulate short orders to drive price lower. And so then price will move lower like so, and it will probably come down around here before it continues moving higher up into our second test, which is just up here. And so once price comes up here, we test. Once price moves down below this, then my stop is at break even, and then I'll look at scaling out when price gets to this level here because this is where we have a high, and I'll be out of the position completely when price gets down here, and unless something radical happens fundamentally. All right, let me remove this tool. Okay, so I hope that answers your question, Even. You're not here. You're probably in bed. It's pretty late there in Australia. Okay, so this is actually a really nice setup. I like this very much. Okay, so now we've looked at that. We've looked at how price reacts at our levels and where we would have our entry placed, our stops, and our targets. But just remember that when you get into a trade, if you have the tendency to micromanage trades, take profits too easily or too early, you have to stop doing that immediately because it's going to completely destroy the probabilistic model of your trading. You have to allow the odds to work in your favor. And if you're in a trade, it's a lovely setup like this one here. We have a stop of about 200 pips. Price goes 100. If I take that trade off, I take all of my profits out, you completely destroy the probability of the entire probabilistic trading model working out because you have to let price do its thing. There's no need at all to take the trade off here. If we come here and price reacts here, and then we continue going higher, which we could very well do, then you just have to make sure that you're not losing money. So if price does have a react here, then maybe either reduce your risk a little bit, so you're risking a little bit less than 1%, maybe go into here and find a micro area of supply to put your stop at. Or just wait and see what happens. This is a weekly chart, so price could sit. This is the daily chart, so price could sit at this level for a week. Or I mean, look how long it took here. When price got up to this area of supply, it sat at this area for 24 days. And so you have to be very, very patient when you're trading the higher time frames. Remember as well that we are selling in line with interest rate swaps. So if the market is doing this, you don't care, you're still earning money because you are getting paid every time the clock strikes 12 at your broker. So this is a really, really, really nice thing to remember, which is why I was so keen on getting it introduced as soon as possible. So don't let this shake you out. Maintain your stance, keep an eye on the fundamentals. If everything is lined up, look at the currency strength indicator. If everything is showing you that you should be holding a position, then hold it and don't fiddle. Okay. Okay, super. So anyway, even that was that. If we have a look at this example just up here, I mean, where would your entry be and where would your stop go? We'll go back to the weekly chart because this is qualified on the weekly chart. You can see here that we had price rallied up, accumulated, and it sold off. This is a beautiful, beautiful pattern, and I actually like this one better than I like this one, because you can see here that we actually had a micro trend line break. So price went up. Let's go to the daily chart. We can look at that closer. So we had a trend line break, which is nice. So price, we had a low, a high, high, low, high, high, and then price broke. The area of supply that broke the trend line was this here, and then price cut away. If we look at this one here, we have a top, and these tops are beautiful because if you study supply and demand in great depth, you'll notice that the good area of supply and demand, those are the ones where you have a very specific pattern. So you have price rallies, it accumulates, and then it sells off. And this pattern here, right here, shows us that we have a very strong disagreement in supply and demand at this level. And so you can sell at these with great confidence, your stop being just over the top. So if we look at this one here, the entry is going to be here. The stop is going to be just above the 132.30 area. You might put it 5 pips or 1 pip or 10 pips above, but just above the area, because you also have to consider that when price moves above this high, then it's fighting with these pockets of liquidity that are likely going to hold price at the lower level. I'm just going to draw something which is pretty interesting. Okay, if you consider this little price structure just here, when price is moving up, ideally you want to get in at an area where you can see there's a disagreement in the market, and you want to place your stop in an area that is far enough away from price and located strategically in a place where price is going to have to really struggle in order to move through it. So this point here, just above this high here, you're going to have, when you look at an area like this, you have very, very thin liquidity here, and then liquidity will pick up very, very quickly, and then it'll wane off a little bit, and then it'll go down, it'll thin out, and then it'll find another area, and it'll pick up, it'll get even bigger, and then it'll come down like that. So there isn't equal areas of liquidity for sale here, 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 and here, and here. There's not a lot for sale here, so this here is going to correspond to a low point, but this one here, this is going to correspond to a high point, like here. And this one here, this also corresponds to something like this, as does this. But this one is going to be located later, like so. So this one corresponds to this just here. And what does this mean? Well, this means that when price is moving up and it hits your entry is just here, just on the low side of supply, so just here. You have to ensure that your stop is on the other side of this little pocket of liquidity, because this is where you're going to get the most protection for your stop. So as price moves into it, you want to make sure that your stop is located in a place where price is going to have to really fight to reach it, because this is where you're going to get the biggest reactions. You know that when price comes up into here, we're moving sideways on this graph, we're moving up on this graph. When it comes up into here, there are going to be so many sellers here looking to sell that price is going to get rejected probably pretty quickly, and price is going to move down. Well, that's what we're hoping for, at least. And so you can spot them just by looking at the structure of price. And if you can't see those with your naked eye, it doesn't matter, because that's why I wrote the software, because it does this for you automatically. So you simply go here, enable supply and demand levels, set this to true. You put your greater period multipliers on 1, 2, 3. supply and demand significance, put that on about 6, and you press OK. And then you can see that, okay, I better put this on the current period. Let me explain this quick. 0, 1, 2. We'll remove the last one that's a bit hefty. So you can see here that the indicator has found them for you. Okay, so we have this one here. This is the first one that we're going to target. We want to sell here. We have another one up here. We have 2 cascaded just above and below each other, just here. We have another one here. We have something else going here, and we have a bunch of them kind of cascaded here at the top. And if there are too many of them here, which there are, you can simply change this by telling the indicator, okay, I don't want to see all of them. I only want to see the really important ones. And how do you tell it to be important? Well, then you simply increase its number. So you can go, for example, to 10. And then the least interesting ones will disappear, and the most important ones will hang around. So now we're only left with the ones at the top. And this is important because price, this is the significant high that we talked about just a second. We said significant high, significant low, significant high, significant low. When price gets up here, it's going to really, really struggle to get through here. And here we have, this is the purple lines, these are the monthly areas of supply, and price will have to fight like mad to get through here. And even a huge crisis, an economical crisis, will not get price to move through this area. It'll come up, it'll stab into this, will saturate the buyers, will absorb the buyers, and then price will shoot down in the other direction. It'll take billions and billions and billions and billions to move price above this high here. And it'll take the same amount to move price above this high here. The reason that this one is better than this one is because that we have a price imbalance here. And price imbalances historically like to rebalance. And currently this one is still out of balance. And when price comes here, then this price imbalance will have been balanced, and price would have moved back to the mean, which is up here. If we go to the monthly chart and just have a quick look, you can see that we have this pattern: rally, accumulation, big strong push. It's the exact same as this one here. Rally, accumulation, strong push. So you have to remember that these price patterns are the same on all time frames. Here we have a weekly one. Here we have a monthly one. So what do we do here? You sell right there, right at that line where the indicator tells you to sell. And if you change the settings on the indicator, it'll tell you to sell right there as well. And so the indicator does all of this stuff for you. But I like to disable it so that we're forced to find these levels ourselves, because it's a bit cheating, if you want to call it cheating. Yeah, that's fine, Christian. Christian has to do a bit of work. That's cool. So the recording will be up when I'm done here. Okay, cool. Yeah, and then we have of course all of these little price structures here. And so what's important to do, I mean, this is kind of a part of the lesson that I'm going to do next week, but you want to find places in the market where price broke trend lines. And so low, high, low, high. Here we have a trend line break. Trend line break. That qualifies this as valid supply. You want to sell here, but do you want to sell here? I don't know. Probably better to sell around here, because this is the child and this is the parent. We're probably going to get a reaction at the child. But if price does manage to move above this high here, it's probably not going to move above this high. So we have all of this black space, and here I refer again to the graph here at the bottom. And so price is going to have a tough time moving above this high just here. Okay, yeah, so we have that one there. Have a couple more orders in there. We have quite a few orders in there. Let's just run these through. We have the Euro-US dollar. And this is another trade that we have on. This is not the super duper trade, but you can see that what I do like On the demo account, I'm selling here. On my account, I'm selling up here. Actually, right at this blue line. And why is this? Well, that's because this is a really nice 4-hour area of supply. But on this one here, this is actually, I had to go down to the 1-minute chart to find this area to sell at. And so the entry to sell on my private account will be here on this low, but on demo account it'll be here, because we want to put some trades on so that we can see what's going on. And you can see here, similar to the euro yen we saw just a minute ago, price rallies, it accumulates, and it sells off. So technically speaking, you want to sell around here, and we'll probably get a reaction there, but I'm expecting price to go a little bit higher up towards here. You can see here that, you see how these wicks kind of went up like that. This tells us that this is, when this happens, price sells. We're thinning liquidity to the upside, so we're thinning out the sellers, thinning them out, thinning them out. So this is not so good when you have wicks like that, because this consumes liquidity. If you want to see this, you want to see price open and then move down. Boom, there's no wick. Open, boom, almost no wick, because this is where price comes to. You can see here. Look at that. Right here, price simply couldn't move higher than this wick here, because price didn't move up in here in the form of a wick and then be rejected. If that would have happened, then price would have gone higher to the place where price had not been back to before. You can see this is a whopping area as well, because we had support. So first test, second test, actually first test, second test, third test, fourth test, fifth test, sixth test, and then price cut through. So this is an absolutely beautiful area to sell at. And we had some magic news, some massive news, sorry, spiked up, and then we accumulated so many sellers on this move higher that price is dumped very, very quickly. All right. Super. Okay. Good. Well, that was a little bit about that. Yeah, I hope it covered your question even. Okay, now we're going to do top-down analysis on a few pairs, and we'll see if we can find something to trade. Before we do that, I want to have a look at the pound, because we talked about this pair last week, and I said that we should buy here. So we said a nice area to buy it would be just here, and price got filled to the pip, just at the same level, and it went up. It went up over 50 pips, and then it came down, and we had some news, and price went down to the lows. Why is this important? Because it's telling us when price goes down this low here, the most expensive price you want to pay for this when buying is the 12200 area. Why? Because price has already been that low historically. So if you have a look at this, what's the low of this? The 121.99. So it went against us half of a pip, and it went up over 200 pips. And so we talked about that. I said if you take this one here, you'd probably want to put your stop. You could put it here, but the best situation would be to put your stop below this low here, because price has already been back to this level. Here we have the area. This is actually a continuation pattern. So we have a rally, accumulation, rally, accumulation, sell off, accumulation, and then price popped higher. So we have a really nice pattern here. We got the reaction, but price needed to rebalance this price inefficiency, and it did so when it came back to the point of origin, which is at the low here, and that's where price managed to hold. But now you can see that price actually has removed this daily demand just here. And how do we use the tools, the Pipnotic tools, to take advantage of that? Well, then you have to look at the area of supply that took out this demand. And can you find that? You can actually see it very, very clearly, and that is this one just here. So we had a gap. We had this happen. So price sold off. We had a trend line break. What does that tell us? Well, that qualifies an area of supply just here. So we have an area of supply just here. It's qualified, which is nice because here we can sell. Price cut through this trend line. This is the one that did it. And price cut down here, and it sat on this area just here, and then it cut through it. So here we're going to have to go on the smaller time frames to get a bit of clarity. And you can see here that price gapped down, and then it just cut through this area just here. So it's pretty clear what happened. But if we have a look, you can see that if we go on the daily chart, this, when price went down, this is the most, this is the cheapest price that you want to sell at here. So if we go to the 4 hour and have a look, and it brings us just to here. So because of the gap, it's a little bit difficult because the gaps normally like to close. Price likes to gravitate to the point of origin for gaps. But I would probably not want to sell this at a price any cheaper than 122.70. So the entry to sell would be here, and the stop would go over the top of this accumulation bar. So we'd probably do something like that. It's a bit of an ugly one, and gaps are terribly ugly and difficult to trade. But you can see also, I mean, not even considering support and resistance, we're just looking at pure supply and demand. You can see that when price came up, it touched this level here, it touched it, and this one gapped down and closed, boom. So this is where we're going to get the reaction, I think. And so this one is gone, so we delete that. The 4 hour area is also gone, we'll delete that. And so we're expecting some kind of reaction up here at the what is that? The 122.70 area, which is great. And you can see here that we have to be a little bit careful because we have a weekly area of demand here at the bottom. So you can see that we had price came down, we had big rejection here, price managed to stabilize, move higher. We had a trend line break. The area, let me draw that trend line on there properly. So we have from this low to this low, we have this trend line break, and which area broke it? So we have a weekly area of supply, which is just here. But as we spoke about just a minute ago, look how deeply into this area of supply price went. So I would be a little bit cautious about, I mean, on the weekly chart, about selling for a price any cheaper than that. But price will very likely react here because this is a weekly chart. So we have daily, 4 hour, 1 hour, and less areas of micro supply in here that price will react nicely at. So, but if you're looking to hold this, then you want to. I wouldn't even sell it here. If you want to get into here on a long term, then you should look to trade here. Why? Because we had price came down to here. We reacted. So something's going on to the left. Let's see if we can find it. I'll go to the monthly. I don't even have enough price. So anyway, somewhere back here historically, so pre-1994, we had some demand. Price dropped, landed on that demand, rejected, it stuck to the area. This is a sign that price is going to cut through it, and price broke through it. So what does that tell us? Well, that tells us that in line with the interest rate swaps, a long position trade would be to sell right there. That would be a beautiful longer term trade. So you could hold that for a couple of months, and even if price is going sideways, you're going to be earning money because we're in line with the interest rate swaps. You'll often find that if this is red, if it's telling you to sell it on a 15-minute chart, it could be going up or down or whatever. But if you go to the higher time frames, then price will be moving in the direction that the indicator is telling you. So this is telling us to sell it. Price is moving down. Go to the Aussie yen. If you go to this is telling us to buy it. If you go to the 4 hour, you can see the price is moving up now. We formed a base, and now we're moving higher. Yeah, so very, very interesting, I think. Okay, super. This is actually a really nice pattern. I'll definitely look to sell there when price gets there, but it could happen weeks or months from now. But for the time being, I think that we're struggling to get through this area here. But we have the Brexit, which is still lingering. We have interest rate hikes in the US, so we have flows moving to the American dollar and out of the British pound. I mean, the currency alone, the British pound currency, I mean, the Bank of England, they were talking about raising interest rates because the fundamental data was supporting like a good stable inflation. So inflation was moving was increasing, and so there was actually talk of raising interest rates. And then the Brexit happened, and then that just introduced an enormous amount of uncertainty, which, yeah, people got a bit nervous, and so people are moving to safe haven currencies instead of the British pound, just to wait and see what happens here. But until everything stabilizes in the UK and they have that, what's it, the Chapter 51 or whatever, until all that stuff plays out and the market, like on the relatively kind of near term, can see what's going to happen, the consequences of leaving the European Union, I think we'll continue to see money move out of the UK. But we'll have to see. Okay, so yeah, you can see here that we have, we would be selling into this area of weekly demand, but we have some pretty decent areas which to sell at here. But you'd have to be very careful. You'd have to manage these very aggressively because we would be selling into this. But we have moved pretty deep into it here. But anyway, so we have a couple of 4-hour areas that we could look at. We have something at the top here. We have this one here. Have this one here. We have this one here. But again, just manage those with caution. Okay, if we have a look at the Aussie, what's going on here? Well, we can see that we have this area of demand, which has almost been taken out. Longer term, we should be buying. I'm not exactly sure how much of a difference there is. Let's have a look. I'm going to have a look here. Okay, it's not so much. I mean, for per 100,000 units. So if I'm buying and selling standard lots, every night I will, if I'm buying, I will earn $1.71. If I'm selling, I will have to pay just over $3. So it's not a whole lot. So you could, this one could go either way, of course. And if it's short term, you don't even have to pay attention to the interest rate swaps. But for the time being, we've fed very deeply into this area of demand. We had some enormous selling here. I missed this short here, unfortunately, by a few pips, but I left it in there because, why? If we have a look at this, you can see price didn't quite get back there. And so I'm expecting price to come up to here, the 75, 40-ish area, and maybe have another go at moving lower. But we'll have to wait and see what happens there. We took shorts up here on this account, but for the time being, you can see that we are moving back to this area of demand that has been tested once in the past. So first test, this is the second test. We have, let me remove all of this crap because it's really confusing. Oh, that's nice and clean. You can see here that we have a trend line that is about to break, or might break. We're testing it now. If this does break, what does that do? Well, that qualifies this area of demand at the bottom. Because, I mean, the reason that they use the trend line break rule is, sorry, Volker, let me let you in, is that it enables us to identify areas of supply and demand that are strong enough to break the structure of price. And how do you structure price on a price chart? You use trend lines. You use like vertical or horizontal areas, trend lines to do this. The indicator is only using horizontal, but it's also using it in the form of supply and demand lines that you can enable and disable. But if price manages to move up here, I think that, well, technically speaking, we'll probably get a reaction down here because the buyers located at this area here, there's a micro area, there's micro demand in here that's holding price. Price came down. We had a very strong rejection, so price moved pretty quickly off here. There was a very short period of agreement in supply and demand for the Australian dollar, American dollar, at this level. You can see price went down very quickly. You would expect price to keep going, but it didn't. It stopped like it hit a brick wall. It accumulated. What did it accumulate? It accumulated buy orders, and then price just shot up like that. And this is showing a lot of strength. We're on the weekly chart as well. You can see how price moved up. We have not been back here. So this is a fresh, untested area of weekly demand. And so we're expecting a reaction. Should price close above here, this trend line, if price comes back down here, we're expecting a reaction and a potential move higher. So if we go on the daily chart and have a quick look at it, you can see that Let me remove those extra lines. You can see here that we have the parent, we have the child, price left very quickly, and now we're doing this. When price does this, I wouldn't sell anything just yet. Of course, we are testing this downward sloping trend line, but when price does this, it makes me a little bit nervous because it's accumulating to do something we don't know what yet. It's kind of doing this, but in the opposite direction, how price went up, now it's accumulating. When it does that, when it sticks to the bottom of an area, it's normally an attempt to move through it. So you can see if price moves higher, we're accumulating orders. They're probably buy orders, and we'll probably have another go at taking out this area of supply. And the area of supply is here, just here. And this is supply. Why? Because it took out this parent demand just here, like so. And so you can see how it was established. It was tested once, twice, and price came down, we accumulated, and then price cut through it. And then you ask yourself, what area of supply took out this demand? This one did. So this one is gone. So we target this to short. If this doesn't hold, we could probably, very likely, assuming that price takes us out, it'll probably get a nice price structure like that. Price will move through it, and then this will qualify this area of demand as demand because it consumed this supply. Then it'll probably come back here, test this, then come up to this area of untested supply, and then move lower. But we don't know. We have absolutely no idea. That's the funny thing. I mean, you sit, you look at a price chart, and you act all clever, and you think you know what's going to go on, but you actually have absolutely no idea what's going to go on, and you have to be okay with that. All you have to do is you have to be able to identify these price-sensitive areas, and you have to know that when price gets there, there's a very high likelihood that price is going to react for long enough for you to get your risk out and get a free look at a potential big profit. Okay, well, I think I'll leave it at that. Thank you all very much for being here, and if you didn't make it, no worries at all. The recording will always be there for you, and that's it. Have a super week. Take care.